Professor Nam-Yong Lee's long commentary, the US S&P 500 ETF. Is this a chance or a bubble? The S&P 500 ETF is not a single stock. It is a relational investment in the entire US system. The US S&P 500 ETF, which Korean investors buy more than any other overseas product, is not a game of guessing individual winners. It is a piece of financial infrastructure that builds a relationship with the entire system of American capitalism. Flagship ETFs, such as SPY and IVV, are designed to track a basket of 500 leading US-listed companies weighted by market capitalization, and the S&P 500 has established itself as a global benchmark index that represents most of the total market capitalization of the US stock market. When you buy one of these ETFs, you should see it as choosing a long-term relational investment that rides together with US economic growth, corporate earnings, the dollar system, and the governance of US regulators all bundled together. From a global perspective, SPY's expense ratio is around 0.09%, which is far cheaper than most traditional mutual funds or domestic active funds. In terms of global standards, the S&P 500 ETF can be regarded as a world best practice product that allows you to board, at low cost, not just one company, but the entire economic system of the United States as a country. From the viewpoint of Korean households, it is much closer to a systemic choice that joins the long-term growth and shareholder return policies of the entire US system than to a speculative game of trying to pick which single company will do well. From the perspective of relational philosophy, the price of this ETF is not just about 500 companies, it is the product of a vast web of relationships intertwining the Federal Reserve's interest rate policy, the US federal government's fiscal deficits and treasury issuance, the global AI investment boom and semiconductor cycle, Korean households' rush into dollars, and the weakness of the won, and the Korean government's trade negotiations with the US and its capital market regulations. The moment a Korean investor buys one share of an S&P 500 ETF on a smartphone, that order becomes a signal that simultaneously nudges New York's capital markets, Washington's policies, big tech names such as Nvidia and Apple, the $1 exchange rate, and the debt structure of Korean households. The S&P 500 is hovering near an all-time high. You must first guard against illusions and temptations. As of early December 2025, the S&P 500 index is trading near its all-time high. After suffering a steep decline in 2022, it is reported to have posted gains in the high 20% range in both 2023 and 2024, and to have added another double-digit increase in 2025, leaving a cumulative rise of more than 50% over the past few years. On the surface, this easily creates the illusion that now is the time to go all in on US stocks. However, global historical experience shows that long-term equity returns have generally converged to around 8 to 10% a year in nominal terms, consisting of about 6 to 7% real returns plus around 2 to 3% inflation. It is very dangerous herd psychology to believe that simply because you saw 20+% annual returns over a specific 3 or 5 year stretch, the same thing will continue indefinitely. If Korean investors chase into the market near the top based only on recent performance, they may end up becoming victims of short-term volatility rather than beneficiaries of the system's long-term performance. Relational philosophy tells us always to see a current position within its web of relationships. The fact that the S&P 500 is near an all-time high does not just mean that the number is large. It signals how much optimism and expectation US and global markets have already priced in. Korean investors should go beyond the simple observation that the S&P 500 has outperformed the domestic KOSPI and first ask what set of expectations and relationships today's price is actually standing on. In the relationship between price and value, valuations are already in historically expensive territory. The S&P 500's 12-month forward price-earnings ratio is currently estimated to be in the low to mid-20s. This is higher than the average of the past decade and somewhat above the average of the past 5 years. By global standards, this already places the market in a significantly expensive band relative to history and should be interpreted as a warning sign that expected returns for the next 10 years are likely to be lower than those of the past 10 years. A forward PE in the low to mid-20s implies an earnings yield of roughly 4%. If you then add 3 to 4% for the long-term growth of the US economy and corporate profits, real growth plus inflation, you arrive at a rough nominal expected return in the 7 to 8% range. This is somewhat below the historical 9 to 10% average. In particular, when valuations are already high, as they are now, further gains require that strong positive forces, such as an AI-driven productivity revolution, actually translate into sustained earnings growth, and that pressure is built into today's prices. From the perspective of relational philosophy, valuation is not just a number, it is the collective outcome of hopes and fears, greed and anxiety, woven together among millions of participants. If, driven by ignorance and a lack of planning, you buy purely on the basis of the last few years' returns, you are essentially reading the relationship between price and value backwards. Korean investors should coolly judge whether the S&P 500 is cheap or expensive, not by gut feeling, but by comparing it against international statistics, historical averages, and global valuation indicators. It looks like 500 stock diversification, but in reality, it is a heavy bet on the top 10 big tech names. Many investors believe that the S&P 500 ETF is safe because it spreads risk across 500 stocks. Yet recent data show that the top 10 constituents of the S&P 500 account for roughly 40% of the index's total market capitalization. In reality, a small group of big tech companies that dominate AI, semiconductors, cloud computing, and platforms are responsible for most of the index's performance. It may look like broad diversification across 500 names, but structurally it carries the face of concentrated exposure to the success or failure of about 10 companies. Index providers themselves acknowledge this reality and even offer separate indices focusing on a handful of large technology stocks at the top. This in itself is a symbolic indication of how dependent today's S&P 500 has become on a small number of names. If expectations surrounding AI were to fade, or if specific big tech companies were to face serious headwinds from regulation, taxation, or antitrust actions, the index as a whole could be shaken at once. That is the structural risk embedded in this concentration. Relational philosophy urges us to look beyond nominal plurality and focus on who actually exercises power. When Korean investors buy an S&P 500 ETF, in practical terms they are taking on a position heavily dependent on the fortunes of a small set of companies such as NVIDIA, Apple, Microsoft, Alphabet, Amazon, Meta, and Tesla. Rather than feeling reassured by the word diversification alone, investors should recognize the risk of concentration and consciously design how to offset that risk through the relationship between this ETF and their Korean assets and other global holdings. Intraday trading and leverage are battlefields ruled by algorithms and institutions. For individuals, they are almost gambling. Many viewers ask whether the S&P 500 will go up or down tonight and whether it is safe to stay up until dawn trading short-term swings. But intraday price movements are already the product of ultra-short-term algorithmic relationships far beyond any individual's control. High-frequency algorithms that move seconds before US economic data are released, institutional hedging around options expirations, rebalancing by large pension funds and hedge funds, and AI-driven quantitative strategies are all colliding with each other at microsecond speeds. In that battlefield, it is nearly impossible for an individual trader to win consistently. Global research repeatedly confirms that most individual traders fail to outperform broad market indices over long periods. From the perspective of the US federal government's FEA framework, Capital markets are intended to be a kind of public infrastructure, supporting citizens' retirement savings and supplying funds to the real economy. When many individuals misperceive this infrastructure as a casino for intraday gambling, leverage, and option speculation, it warps the relationship structure in ways that strain both household finances and national financial stability. From a relational philosophy standpoint, I would like to encourage viewers to see the S&P 500 ETF not as a tool for day trading, leverage, or options gambling, but as a vehicle for long-term accumulation with a minimum horizon of 5 years. The desire to capture a few points overnight is usually nothing more than a combination of ignorance and greed. If instead you place your income and expenses, debts and retirement, your family's life cycle and health, and your job stability at the center, and then calmly design what kind of relationship you want to build with this ETF, the very same product can produce completely different outcomes. For the next 6 to 18 months, you must coolly assess the structure through 3 scenarios. The outlook for the next 6 to 18 months is not about fortune-telling a single direction, it is about designing a structure that manages risk across multiple scenarios. The first is the baseline scenario. Current market consensus is close to a soft landing, in which the US economy avoids a sharp recession and instead experiences a gradual growth slowdown with step-by-step rate cuts. In this case, S&P 500 earnings could grow around 5% a year, and valuations might slowly adjust downwards from today's somewhat elevated levels or remain roughly where they are. Under such conditions, the index could see annual swings of plus 5 to 15% interspersed with corrections of around minus 10%. The second is the downside risk scenario. This could unfold if inflation resurges, if the AI investment boom cools and a correction takes hold, or if geopolitical risks in regions such as the Middle East, East Asia, or Europe severely disrupt the real economy. In an environment where both valuations and concentration are high, it would not be historically unusual to see the S&P 500 fall by 15 to 25% or more in a single episode when an unexpected shock hits. If the tech-heavy Nasdaq slides sharply, an S&P 500 ETF, loaded with top big tech names, will inevitably feel the impact. The third is the upside extension scenario. This would require AI to deliver a genuine productivity revolution, the Federal Reserve to cut rates faster than the market currently anticipates, and geopolitical risks to ease. Under such circumstances, elevated valuations could stretch further, and the S&P 500 might set new all-time highs with another 10 to 20% advance. But even in this case, the right attitude is not, "I will jump in now and pocket quick gains," but rather, are we approaching the far end of an overheating phase? The 6 to 18-month horizon is not a window for guessing the direction, but a period for checking how much volatility you and your household can realistically bear across these scenarios. For Korean households, the S&P 500 ETF offers currency diversification and a hedge against national risk, but you must also quantify tax and policy risks. Korean household balance sheets remain heavily skewed toward real estate, domestic deposits, and domestic equities. By allocating to the S&P 500 ETF, you are diversifying into dollar-denominated US real and financial assets, and thereby partially hedging against the depreciation of the won and against Korea-specific economic and political risks. Given the structural challenges facing the Korean economy, such as low birth rates, aging demographics, and declining potential growth, allocating part of your portfolio to the world's largest economy and key reserve currency issuer accords with global standard risk management practice. However, you cannot simply follow this logic blindly. First, there is exchange rate risk. The S&P 500 ETF is a pure dollar asset. In phases where the won strengthens sharply and the $1 exchange rate falls, the index can rise while your return in won terms is cut back. Second, there are tax and health insurance risks. Distributions from foreign-listed ETFs are treated as financial income in Korea and taxed at a set rate, and if your financial income exceeds a certain threshold, It is combined with other income for comprehensive taxation and may increase your national health insurance premiums. Tax laws and systems change frequently, so you must check guidance from the National Tax Service and, if necessary, consult a tax professional. The U.S. federal government's FEA framework seeks to design the finances of households, firms, and the state within an integrated nationwide resource management system. Korean households should adopt a similar mindset and view their own balance sheets as part of a single ecosystem linked to national fiscal policy, monetary policy, and global capital markets. You should map how housing values and key money deposits, domestic deposits and bonds, the national pension and retirement pensions, and the S&P 500 ETF are interconnected, which link is likely to snap first when a shock hits, and whether you and your family can withstand that. This is what genuine asset design looks like through the lenses of relational philosophy and FEA. Attitude matters more than direction. You must hold to the principles of time diversification, asset diversification, and net return thinking. The real question about the S&P 500 ETF is not whether it will go up or down. It is how much of it you will hold, in what way, and for how long within the context of your life's overall asset structure, cash flows, and risk tolerance. First is time diversification. Instead of going all in with a lump sum, you should spread your purchases over multiple years, making regular contributions and managing your average cost. Global best practice shows that long-term systematic investing has produced far more stable results than attempts at market timing. Second is asset diversification. Concentrating solely on the S&P 500 ETF is not so different from going all in on Korean real estate. You should combine Korean equities and bonds, cash, other regional global ETFs, and safe haven or cash-like assets in a balanced way to reduce your overall portfolio volatility. Third is a net return perspective that fully factors in taxes, health insurance premiums, and currency effects. Do not be blinded by headline nominal returns. You must carefully calculate how much real profit remains after deducting taxes, accounting for changes in health insurance contributions, and adjusting for exchange rate gains or losses. This is the most practical study you can do to overcome ignorance and greed. Finally, this commentary is not a recommendation to buy or sell any specific S&P 500 ETF. Its purpose is educational, to help Korean citizens think for themselves from the perspective of systems and relationships. The ultimate investment decision and responsibility always rest with each individual investor. In summary, the S&P 500 ETF remains a valuable gateway for riding, over the long term, on US companies and the dollar system at the heart of global capital markets. But at today's level, the market is historically expensive, and there are structural risks arising from excessive concentration in AI-related and big tech stocks. Rather than obsessing over how many points the index might move tonight, Korean investors should instead ask what kind of relationship they want to build with the S&P 500 ETF over the next 10 years within their own lives and within the national asset structure. I would humbly submit that this is the mature path for citizens who wish to rise above ignorant, inept, and greedy herd behavior. Thank you for watching Professor Nam Yong Lee's long commentary.